Hi, I'm Thomas. Welcome back to the course Corporate Finance. Today's topic is dividend and reinvestment policy. Let's look at an analysis of excess cash to begin. This will be the source for dividends or other options for the company. A company needs to have some cash on hand as part of their working capital. So a possible metric would be 3 months of operating expenses. For this company, $40,000 of monthly operating expenses times 3 is $120,000, and with a cash balance of $200,000, the excess cash beyond the working capital needs is $80,000. That's the cash that we're looking to put to work in the various options we're going to consider. What are those options? One is dividends, and we will look briefly at the concept of dividends. We'll actually focus more on other options for excess cash. Debt paydown. Generally, debt paydown is only if the bank is requiring it. Most companies want to borrow as much as they can, and when they have debt, they want to keep it outstanding. So the debt paydown would probably be only at the request of the lender. New investments are options. Financial assets such as stocks and bonds, fixed assets such as machinery, equipment, buildings, and acquisitions. Acquiring companies is another form of investment, and we'll look at an acquisition example in detail. And finally, share repurchases. A company can purchase back their own shares from the market. They go into treasury, they become treasury shares, and we'll look at an example of share repurchase. Just like buying any company's equity, a company usually repurchases its own shares because they believe they are undervalued and they would like to capitalize on that undervaluation by acquiring them at a low price, holding them until the price goes up, and then selling them back into the market at a profit. There are other reasons for share repurchases as well, but that's the perspective we'll consider in our analysis. Let's begin with a company valuation. Knowing how to value a company is a nice tool. There are various ways to value a company. Here, we're valuing a company based on a multiple of EBITDA, earnings before interest, taxes, depreciation, and amortization. For our company, that measurement is $150,000. We're applying a multiple of 6 times. This multiple would come from a comparable companies analysis based on looking at comparable companies. What is their total value? What is their EBITDA? And what is the multiple relationship between the two? So we've decided that the correct multiple for our company is 6 times EBITDA. That gives us a firm value of $900,000. The entire entity is worth $900,000. We subtract debt because that portion of the value isn't for the owners. What's left is the equity value of $620,000. We have 100,000 shares outstanding. On a per share valuation, the company's operating value, and not total equity value because there's an additional component we'll factor in, the operating value per share for the shareholders is $6.20. Now remember, we have our excess cash to consider as well. One common way of accounting for excess cash is to reduce debt, assuming that the acquiring company will use the excess cash to pay down debt. In this case, we want to consider the cash as a separate component of value for the shareholders. There's $80,000 in excess cash, again, cash beyond the working capital needs of the company, divided by number of shares gives us excess cash per share of 80 cents. And so each shareholder has 2 components of value. The operating value per share, which is based on the ongoing company operations of $6.20. The equity value, the excess cash per share, which is on a per share basis 80 cents, summing to a total equity value per share of $7. Now let's consider the decision to pay a dividend. In theory, the cash, whether it's in the corporate bank account or is distributed to the shareholders and is in the individual shareholders' bank accounts, is cash that belongs to the shareholders. So in theory, there would be no difference between keeping that cash with the company or distributing that cash to the owners. Now, practically, there are factors to consider. One is the control of the cash. When it's with the shareholders, they can decide what they want to do with that cash. They have full control over that asset. Other factors listed here are signaling. A company sometimes pays a dividend to signal their financial strength, and in particular, companies like to consistently increase the dividend to send a signal to the market that they're financially strong and capable of continuing their dividend and growing that dividend. Another factor is the tax effects of dividends. When a company pays a dividend, it's not tax deductible. It's not an operating expense, but it probably is taxable for the individual receiving the dividend. And so there's some loss of value in the group of the corporation and the investors, the shareholders, when a dividend is paid out, because there will be a tax effect to the dividend received by the shareholder. And another factor is whether there are attractive investment alternatives. A company doesn't want to have excess cash sitting in the bank not being put to work. If there are attractive alternatives for investment of that cash, then the company will consider pursuing them. If there aren't any, then that would be a good reason to pay the cash back to the shareholders, acknowledging that you can now take control of the cash, make your own investment decision. We don't have good investment opportunities for your cash, so we're going to give it back to you in the form of a dividend. Let's consider an alternative use, investing in an acquisition, acquiring an entire company. So we have our company, as we've already valued. In the center of the screen, we're evaluating a target. This company has $8,000 of EBITDA and an asking price of $80,000. So we calculate pro forma. Pro forma means after the transaction. So our pro forma would show the company after acquiring the target. And as we work down the same analysis we did for our company in the valuation, using the multiple of 6 times, which is our company multiple to EBITDA. With the additional EBITDA, our firm value has increased. There's no debt on the part of the target. So our debt value, our debt amount hasn't changed. Equity value is up slightly. Same number of shares outstanding. So now we have an operating value per share of $6.68. And that's the only value for the shareholders. There is no longer excess cash because we've used that cash to acquire the target. And at the end of our valuation, equity value per share is now $6.68. The share value of the company has decreased. The share value that is the wealth of the shareholders has decreased. This is not an acquisition that we want to pursue. When we see that the new share price is less than the old share price, that's an indication that this is not an attractive option for the company. This is not an attractive investment. Another way of evaluating this transaction is comparing the EBITDA multiples of the company and the target. In our multiple calculation for the target, a valuation of $80,000 divided by EBITDA of $8,000 gives us a multiple of 10 times. That's a higher multiple than our multiple of 6 times. Generally, that means that this will be an unattractive acquisition. It's going to result in a share price decrease for the acquirer. Now, if there is growth, if there's above average growth that is projected to be realized by the target, then that would be a reason to pursue this acquisition, and we would evaluate that acquisition with a more complete future cash flows analysis, with the cash flows discounted back to the present to take into consideration the fact that the EBITDA isn't going to stay at $8,000 annually. It's going to increase over time. But without that information, this would not be an acquisition that the company would pursue. If they could decrease the purchase price below $80,000, with the same EBITDA, the multiple would also go down, and as that multiple approaches 6, or possibly even lower than 6, the acquisition becomes more attractive to the acquirer because it would result in a favorable share price move. The share price would go up if we're buying a target that has an EBITDA multiple less than our own. Let's look at another alternative, share repurchase. This is purchasing shares, our own shares, and putting them into the treasury, so they're no longer shares outstanding. In this scenario, our valuation is the valuation on the left, and we've already seen this valuation. This is $7 per share. The valuation on the right is $6.25 per share, and the key number driving that valuation is the multiple. The market, the universe of individuals and companies investing in the stock market, has applied a multiple of 5.5 times EBITDA to our company. We're using a multiple of 6, and we believe that we have perhaps better prospects for the future or more stable performance than the market is giving us credit for. Therefore, they're using a slightly lower multiple, and as we work through the valuation, that results in a lower share price. Currently, our shares trade at $6.25 per share. We believe the correct valuation is $7 per share. This is a buying opportunity. Our shares are undervalued based on our valuation, so we have the opportunity to buy them at what we believe is a low price, and we anticipate that the market will come around, adjust their valuation for our company, the stock price will increase, and then we will sell our shares back into the market for a profit. Let's look at that analysis. Currently, we have $80,000 of cash. The market price per share is $6.25, and we can therefore purchase 12,800 shares given the excess cash available to us. At some point in the future, and we would anticipate that this would probably happen within a 12-month period, the market realizes they've been undervaluing our company. They change the EBITDA multiple to 6. The valuation goes up to what we believe is the correct value of $7 per share. We therefore sell our shares and we realize profit. We bought for $6.25, we sold for $7, and now the proceeds. We have $89,600 in cash proceeds. Now there are some simplifying assumptions in the price per share at which we buy and the price per share at which we sell. The valuation in the market and our valuation is based on us having excess cash. Once we buy shares, that excess cash goes away, so some of the value is lost, some of the value that was affecting the stock price is lost. But another important factor is the total number of company shares outstanding goes down. And that means all of the equity value for the company is allocated to a smaller number of shares outstanding, which is beneficial to the shareholders. We're simplifying by taking those factors out of the analysis and simply going with the 2 share prices that we've already calculated. There would be some slight differences, but for the concept that we're learning here, these simplifications are fine. So again, what we see is we invested $80,000 in our stock. We then sell the stock and realize proceeds of $89,600. Now let's see how that affects the share value. The multiple is 6. This is now the market valuation. The market is using the same multiple as we have determined is the appropriate multiple, 6 times of EBITDA. We work down our analysis, and operating value per share is the same because there's been no change in our operations. But there is a change in excess cash. Now we have $89,600 because of the favorable result of buying our shares and selling our shares. We have more excess cash than we had previously. On a per share basis, that's 90 cents per share. And now when we add the operating value and the excess cash per share, the equity value per share to the shareholders is $7.10. Previously, that was $7, and the shareholders have realized a 10-cent per share increase in value based on the profit that came from buying the shares at $6.25 and selling the shares at $7 per share. This concludes the lecture on dividend and reinvestment policy. We spent more time looking at investment opportunities than we did looking at dividends. Remember, the general concepts relating to dividends we've discussed in this lecture are that a company will pay dividends for several reasons. Some of those relate to communicating to the market the position or the strength of the company, and some of those relate to the relationship between the company and the shareholders. In general, if a company has an attractive investment opportunity, then they will pursue that investment opportunity because the shareholders have invested in the company. with the desire that the company provide a return on that investment. And we've looked at two types of opportunities for investment for a company. One was acquiring another company, and another was acquiring our own shares through a share repurchase. And we looked at those two scenarios to analyze whether given the information in the scenarios, whether the results were attractive to the shareholders as alternatives to paying cash to the shareholders in dividends. This concludes the lecture. We'll work together in class to be sure you understand how to apply these concepts in real-world scenarios, and I look forward to seeing you then.